what to watch the rest of the year. So this, do you see this trend here? Right? So this is increase. So what do we buy? When we buy equities, what are we buying? We're buying future earnings. That's all we're buying. And to the extent that we want to buy a company that produces a certain good, solar panels, that's fine, but we wouldn't do that if that company had no future earnings. It would make no sense. So what we're talking about here is a trajectory of earnings. So there are two parts to earnings, increasing earnings. Anyone have any idea what those two parts are? Cost cutting, increased revenue. So that's margins and revenue. So what we're seeing here is the combination of both. So in 2010, there was a 45% increase in S&P 500 earnings because of cost cutting and revenue. So there's about 6% of that was revenue, the rest was cost cutting. Okay? Here, about 6 or 7% revenue, rest cost cutting. Here, we won't get this, by the way. So these estimates are being cut right now. We'll probably be more like 7% by the end of the year. And about 7% of it will be increased revenues. So cost cutting, we're at the end of the cost cutting cycle, probably. The challenge is the only place that we're going to be able to get growth is revenues. This is fantastic. Why? How do we make more revenues if we can't cut more costs? Hire people. You almost have to hire people. And we've already, and we've seen one chart. We'll see some more charts about employment and those issues. But once you winnow out all those costs, you have to hire people if you want to grow. And they do want to grow. They definitely want to grow. There's no question. So even though we have 7% probable here at the end of the year, this is actually coming down really fast. So we have 298 of the Fortune 500 companies have reported earnings so far this season. If you strip out financials, we have no growth. We've lost earnings if you don't have financials. That's earnings. With financials and regular companies, everyone together, we've lost revenue so far. And the expectation is for the rest of the companies to actually have a reduced revenue stream even more. So right now we're at 0.3% reduction in revenues for this quarter. Now, if Europe isn't resolved by the end of this quarter, which it won't be, and if China is still in slowdown mode, which it will be, it's very unlikely that we see this 12.4 in 2013. It'll probably continue this trend, right? This is economist estimates. They always estimate that out far. Now, they're going to start cutting those estimates, and that's what they're doing. Okay, there's a lot of movement here. It's very small. I'm just going to try to explain a couple things. Is that a red line? I think it's a red line right there. That is inflation. That's the cumulative change in prices from 1800 to 2012. This line right here in the middle, that's where the Federal Reserve was founded. Okay, that's the Federal Reserve coming into existence. Note that above this middle line here, inflation, below it, deflation. Except for the Great Depression and this little blip in 2008, there is no deflation after the Fed is founded. So we're starting to believe in fairies. We're starting to believe that no economic problems actually exist. And that's been built up from this date forward. So this is a huge, predictable inflation is a huge benefit for borrowers. It's a huge, huge detraction for consumers and spenders. It's a big, big negative. So this really helps companies and people who buy houses. That's all this helps. The people this really hurts is us who consume. So just since, let's see here, 700 was 1982-ish. So just since 1982, the cost of this basket of goods has doubled. Okay? Since 1945, it's up 14 times. Okay? So this is a huge issue. And this, when you're talking about retirement planning, which is 95% of what we do is retirement income planning, this is the dragon we have to look out for. Right? It's not market volatility. It's not, this is it. This is inflation. Because over a 30-year period, if you don't double your income stream, you basically lose pace. You cannot maintain your lifestyle. So Fed Reserve controls inflation theoretically, right? We'll see. Okay, home sales, two things, and we'll go by this. See this right here, this little blip? Two positives, two positive ups, and then this little down right there? That's the home buyer tax credit. So we always talk about this when it happened. Oh, you're just going to borrow from future purchases, and no one believes you until you get a chart that says, look at that, we just borrowed from future purchases. And if you think about it, if one of us is going to buy a $500,000 house, an $8,000 tax credit is nice, right? But that's not going to, the person that's not buying the house, it's not going to make them buy the house. It's only the person that was already going to buy the house 6 months from now that's going to go, oh, if I buy it now, I get the $8,000 tax credit. So that's all that does. When you have that kind of stimulus, it just borrows from 6 months from now. And that's exactly what that chart shows. There's two stories I hear in media, both of which are completely acceptable stories, both of which completely disagree with each other. The first story is housing is bottomed, we're going to go up from here really, really, really slowly, and that they may be totally right. The second story is foreclosures were basically, there was a kibosh on foreclosures up until a couple months ago. And so they're just picking up again. So what I did is I went and I looked at Berkeley Voice 6 months ago, where they put foreclosure notices in the Berkeley Voice. And in the Berkeley Voice, 4 months ago, there's 4 Berkeley foreclosure notices. And there's realtors in the room, so I gotta be careful. But 2 weeks ago, the Berkeley Voice had 5 pages of foreclosures, 6 or 8 Berkeley ones on every page. So it is kicking up again, and it is kicking up locally as well as everywhere else. That doesn't necessarily mean that it's going to be such, a big deal that it's going to drag down the housing market. Right? That's not what that means. It just means it's picking up again, and we don't know where it's going to go. But here's the thing. If we have a bottom in housing, and we've seen this chart before, the number one additive to confidence is our housing value, in terms of how it makes us feel, how it makes us spend, how it makes the economy hum. The number one thing is housing value. So if our housing values go up, the Fed will signal rates will go up. People that are on the sidelines have to jump in to get the low rates, and we start sort of a cycle, if it's really a bottom. So right now, in my mind, it's a media fight. One of them is going to be right, and it's really the one that's the loudest, probably. Because if you think about it, the more we think it's a bottom, the more the banks won't just throw stuff on the market to get rid of it. They'll hold on to it and wait for it to go up in value, right? Because banks are holding a ton of inventory. Does that make sense? Does anyone have questions about that? Okay. Oh, this is a real quick slide. So we see this as the end of June. It's actually through May. The latest numbers that popped, okay, the numbers came up 2 days after the announcement was made by U.S. Supreme Court that it's legal. So what do you think happened to the healthcare bill was legal, okay? What do you think happened to Small Business Optimism Index 2 days after that announcement? Right, it plummeted. It gave up all its gains for the year, which is interesting because I know a lot of small business owners that don't think it's that bad a deal. I actually think that my health insurance costs go down eventually with the health insurance bill. So that's more a political statement than it is an economic statement. It's just interesting to see how things move, and I'm assuming that will actually repair itself eventually, that dip that we just saw. The important thing here is we're reaching the bottom of the long-term average, and we've been fighting for that since the crisis. We are coming up out of the hole in terms of small business confidence. What does that mean for hiring, for plant and equipment purchases, for raises, for what's that mean for spending, for business spending? It's all very positive. Okay, we've kind of talked about this already. Unemployment rate, there's a trend. It's headed in the right direction. It's not there yet. It's going to take a long time. Fiscal cliff. This is idiocy at work, okay? So this is our Congress. This one right here, $98 billion. This is when they could not get the debt ceiling raised. They said, okay, if you give us defense cuts, we'll cut this. And we'll sign on to that with the agreement that we're going to work it out before those cuts happen. January 1 of next year is when those cuts happen. Obviously, they're not going to work it out. They forgot the fact there was a presidential election cycle, forgot the fact they don't work together to begin with. So this not going to happen. 0.3, 0.6, 0.8, 1.8. That's a estimated percentage effect on GDP if these things all happen as they are currently legislated. Okay, so I want context for that. The second quarter GDP of this year just came out. The first reading is 1.5%. The estimates out there for the rest of the year are 2%. So let's be nice and let's say it's 2% for the year. Okay, if we have a 2% GDP rate going into 2013, and this all happens, that is 3.5% of GDP. That's an immediate recession, right? There's only one way that we can avoid recession if this all happens, and that's if people who get higher taxes and their payroll tax cuts expire decide to lower their savings and keep spending. Yes?
Can you just define percentage of GDP? What does that mean?
So GDP is our growth year over year, right? So this quarter we've grown 1.5%. So this 0.8, 125 billion is the percentage of GDP, right? That's the percentage of our total GDP. Take 125 billion over 15 trillion, okay? Very small percentage. But if we remove that from the equation, we remove that level of growth, that level of money that could be spent in the economy, okay? So this is money that the federal government is spending, right? This is money that we're spending. So this is increased taxes, this is reduced spending. What that does all in is a 3.5% cut in GDP. If Congress does nothing whatsoever, all of this money that's currently circulating in the economy goes away. And this is the important understanding, is if you, right now, this is what we're spending, 3.6 trillion. This is revenue we're bringing in, 2.4 trillion. You can't do that infinitely, right? If you go back to that Europe chart where the rates were up here and then it converged and then it broke up again, when it converged, that's what this is. That's what we're doing, is we're borrowing because it's cheap. Eventually this has to stop. But here's the problem. How do we stop this? Because if you take Medicare, Medicaid, add Social Security, add defense, add interest, you've used more than the revenue we take in. Right? You have to cut everything in drastic amounts because, and guess what? The punchline gets better, the joke gets even better. Social Security, Medicare, Medicaid, and net interest, those costs are going up drastically because the baby boomers are retiring. They're all logging into Medicare for the first time. They're all getting Social Security for the first time. And if interest rates tick up, we're borrowing more. And at the same time, our interest rates are going to tick up 0.5%. I mean, most of that debt there's no rate on it, right? It's cheap money. But if it goes up a little bit, you double the cost on it. That's crazy. So this has to be gotten under control. And there's two ways. We can reduce spending, we can raise taxes. We have to do both. There's no question about it. Either party that says they can do it one way or the other, they're lying for votes. Simple as that. They're lying for votes, right? So budget tells us what we can't afford, but it doesn't keep us from buying it. William Feather.